Welcome back to the channel, guys. I'm your host, Buckning, and today we're going to update the portfolio as we do every single week. We're going to update trackyourdividends.com. We're going to update Sharesight, do it as quickly as possible so we can talk about how I was wrong about the increase in Prime, Bank of Canada, that interest rate that everyone seems to be talking about. And so, yeah, so if you're new to the channel, welcome. This is where we put $100 a week into a tax-free savings account to build a dividend portfolio right in front of your eyes. And if you're not new, welcome back. So today here at the end of the week, the portfolio closed out at $14,442.09. We're up $353.84 on the day, up 2.49%. For the 1 week, we're up $801.81, up 5.83%. For the 1 month, up $789.05, up 5.74%. For the 3 months, we're only down $66.78, down 0.46%. For the 1 year, we're up $26.27, up 0.18%. And for the all, we're up $1,164.51, up 8.7%. It's been a great week, definitely for sure. We've had quite strong weeks for the past, 3 weeks or so. And even with the rate increase that happened a couple days ago, that I was completely wrong about, it seems like the market sentiment is changing a little bit. And so, and we'll talk about that in a bit here, but we'll look at what we have in the cash account, which is $54.97. Today we did make a purchase, but of course, every single week we do a fractional buy in the Vanguard S&P 500. Ticker symbol for this one is VFV, closing out at $94.20 Canadian, up $2.55 on the day, up 2.78%. We now have 13.38 of a shares, total position value of $1,261.31. Our average price of getting in now is $93.64, which is much lower than the $94.20. So that is a good thing. And it holds about 8.7% of the portfolio. Today's return is completely wrong in there, and total return is wrong as well. Seems like fractional buys affects that. So you can see here we were able to purchase 0.2653 of a share at $94.21, which came out to about $25. The next position we did buy was not any specific strategy where I think Bank of Montreal is a great bank. Ticker symbol for this one is BMO. And no specific reason on why I bought this, but just but just to rebalance the portfolio, because we were starting to get heavy in some areas and losing holdings in a certain area. So Bank of Montreal closing out at the end of the week at $127.80, up $1.46 today, up 1.16%. We currently have 11 shares now, total position value of $1,405.80. Average price of getting in is $103.01. Holds about 9.7% of the portfolio now, which is great. We want to stay around that 9%, above the 9%. Today's return was $15.35, up 1.1%. And our total return since owning this position is $272.73, up 24.7%. And we bought one share here at $127.05. So that is the portfolio, everyone. Those are the positions we bought. And it's just been a great week here. As you can see here, we're up 5.83%, and really no downturn. It's great to see, and it feels good. So we'll head over to trackyourdividends.com here and give you the update here. Portfolio on here is $14,227 without the updated position. Portfolio yield is 4.01% if you were to build this portfolio as it stands without the updated positions. And our yield on cost is 4.34% with an annual income of $570. Now, I did notice there are a few things that are off about this. This here is not the price of the stock of Qualcomm, and this is, I don't think this is the same price for Cisco as well, but I do believe it takes into the factor the exchange rate, which is quite a lot these days when it comes to converting Canadian dollars to USD. And yeah, I think it's just throwing things off, but that's okay. So, because usually we just use this to track how much dividends we are getting for the year and close to the yield on cost there. So it gives us a pretty good idea. But we'll go ahead and add those holdings, and we'll start off, of course, with VFV.TO, which is the Vanguard S&P 500. We were able to purchase 0.2653 of a share, and the cost came in at $94 and roughly 21 cents, but we'll put in every decimal point there. And of course, it's gonna do its rounding thing that Track Your Dividends does. We'll go ahead and add that. So portfolio yield now sits at a 4%. Our yield on cost is 4.33, and we have made $1 for annual income, which is totally fine, $571. And we'll go ahead and add the next holding, which is BMO, Bank of Montreal, and we are in Canada, so it's BMO.TO on the Canadian Stock Exchange, and we were able to buy one share at a cost basis of $127.05. We'll go ahead and add that holding, and there you go. So portfolio yield is back to 4.01%. Our yield on cost is 4.33%. With, of course, the strategy of dollar cost averaging, and our annual income has gone up to $576 for the year, of course, divided quarterly. So let's look at BMO. We got 11 shares. Price today closed out at $127.80. There was a change of $1.46. We already gone through that, and our average cost is $103.01, and we have a profit of roughly $272.69 with capital appreciation. Dividend yield is 4.35% today, and our yield on cost is 5.4%, which is a whole percent more on return on investment. And the annual income from BMO now is $61.16. Of course, you want to divide that by 4 because it's paid out quarterly. That amount is paid out quarterly, not $61 per quarter, but the total amount. Now I'll head down to VFV. We got about 13.4 shares with Track Your Dividends tracking, I guess. And we're getting $15.76 per year. Our yield on cost is 1.26. Today is 1.25. Still fairly close as we put in less of an amount in there. And so that is trackyourdividends.com, completely free to use. Not the most accurate in my opinion, but I could be wrong, and I could totally be using this platform wrong. So that's Track Your Dividends. Next, we'll head over to Sharesight, which I already updated, and way more accurate in my opinion. And you can see I'm red in a lot of positions, which is fine. So what I love about Sharesight is, of course, now I pay for this out of my own pocket because I have more than 10 positions for this portfolio specifically. But what I love about it is it uses capital appreciation, takes dividends into factor as well, and the currency gain from foreign exchange. And then it gives us a total return. So capital gains roughly with all the updated positions, we are down 9.73%. Dividends, we've received about $377.59, which equates to about 2.41% of a return. And a currency gain of 1.37%, which is about $215.10, which brings our total return only negative in the red, $935.33, only down 5.96%. So that's why I love it, because it consolidates all the returns together, taking into factor dividends and currency gain or foreign exchange, which is, it does play a factor in your portfolio. So those things do matter in a sense. So I'm just happy to see that we are not negative 10 or more than double digits. We are in the single digits in the red. And who knows, this year might end off pretty well. So that is Sharesight, and we'll just head back to here, make sure that screen doesn't shut off. But I was completely wrong. Now I'm not completely upset that I was wrong. Actually, it's actually a good sign in my opinion. that, you know, what I take out of that is everyone was expecting a 75 basis points increase in the interest rates, and we only got 50 basis points, which is way better. And that just goes to show, I think, the fact that I think market sentiment is changing a little bit, which is fine because we didn't have like these harsh drops in the market after that happened. Now we do have to consider that Canada is not the leading indicator for the economy. For sure, that's not, a lot of people pay more attention to what they do down south. And so, am I completely wrong? Yeah, I'm completely wrong in the fact that we didn't go up 75 basis points. We only went up 50. But does that mean they're going to stop raising interest rates? Probably not. We'll, like Tiff has said, we're going to keep going until inflation is down. It's, you know, that 1 to 3% range, and he's willing to do almost anything to get us there, which is, I think, a good thing, because who wants to pay huge inflationary prices on goods and services, and it tames really the economy in that sense. Now, so next interest rate hike or discussion will happen in December. And from what my understanding is, because I've never seen too many interest rate hikes, is that they've never raised interest rates in the month of December, but this could be the first time. So that's one thing to take into consideration. The other thing is that to take into consideration is that Tiff himself is really hoping that employment goes down and unemployment goes up, and the reason for that is to have less capital being not circulated but used in the market. That slows down the economy, because if you're not spending your money, it doesn't grow things, it kind of slows things down. And so that's, as much as we don't want to see that for people's well-being, sometimes it just has to happen in order to, you know, control this inflation that is happening. And I know everyone keeps hearing about inflation, and we're really just beating a dead horse at this point. But those are the things that we need to understand. They're not doing it just to ruin people's lives. There is a reason behind it. There is actual validity around it, and you know what? There's never ever going to be pleasing of all people. There's always going to be opinions, which is fine. We live in a free country, and you have every right to your opinion and how you think Canada should be run. But all I understand is that it is a good thing for us. Just means our dollar goes a bit further and inflation gets under control, and we can get back to spending at reasonable prices. Because I don't want to buy an old car for $15,000. I really don't, because that's just crazy to me. I don't want to overpay for a home. And the good thing is that now that I think we're in a place where we're so far down in the market, and your portfolios might reflect that. Your whole net worth might reflect that. But the more we go down, the less downside risk there is when you start investing. And now this is not financial advice, but it's that opportunity where less downside, more upside in this time of, you know, economics. And if you start investing throughout the whole year, you know, the downside for somebody who continually invests on regular intervals may have lost, you know, paper gains, lost on paper quite a bit. But now the downside is much less for those that are just starting to enter the market. And that goes for a lot of different assets. And so other than that, guys, that's pretty much it. I was wrong. And again, I'm not going to ever be right. I don't know how the market reacts to this stuff. And I never will know for sure. I just fly by the seat of my pants and just do what I do best, which is invest at regular intervals, keep it consistent, and increase the amount I, you know, invest. not specifically in this portfolio, but in other ones that I do have. So hopefully you guys have a great weekend. Hopefully this wasn't too long of a video, and don't forget to leave a like and subscribe, and we'll definitely see you guys in the next one. Bye.